Hi, everyone. Welcome to another episode of Get Social with Bond Finance. My name is Sarah Wilkins, and I'm sat here today with Bruce Mannering, who is a director of Bond Finance. Hi, Bruce.
Hello, Sarah. How are you?
I'm good. How are you?
Very well indeed. It's nice to be back doing these videos again.
It's so nice to be back doing these videos again. What are we going to chat about today?
Well, I get lots of questions regarding what are the funding options for when I'm refurbing a property like a BRR, buy remortgage, buy refurb remortgage BRR,
Yeah,
and there's basically three classic options. And I just thought it'd be nice just to run through the different options. We can have a video on it. And then when clients are talking to me about it, they can just have a look at the video once they've spoken to me.
which is a great idea. You have a video hub on your website, don't you?
Yes, yeah. So if you just go to Bond Finance, and
Mhm.
right at the top, there's a little button that says Video Hub. You can just press on there. I think there's about 8 or 9 different videos covering off different subjects.
Yeah, great, 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 great. Okay, so let's go ahead.
All right, excellent. So the three classic ways, okay, for refurbishing, getting the funding for refurbishing a property. So the first one is basically a traditional bridge. This is what many people refer to or know, where you basically get 75% of the purchase or value. The interest is deducted for 12 months. So your net loan, even though you're borrowing 75%, your net loan comes down to 63%.
Mm.
Now, things have moved on in the market and we can now get funding. Well, because you're adding value to the property, lenders will now lend up to 80% and they'll roll the interest on top. So it means you put less money in. And the final option is basically when you're getting 75% of the purchase price with the interest added and 100% of build cost. And that can all be rolled up to 70% of the end value or loan to GDV. So let's go through the numbers, some live cases, so we can actually see where it all fits.
Okay.
So the first one is your classic bridge. Now, most people think, oh, I'm getting a bridge for 75% of the purchase price because they're sort of thinking it's like a buy-to-let mortgage. It's not. Buy-to-let mortgage is basically when you service the debt on a monthly basis. 9 out of 10 bridges, the interest is deducted. Some you can service, but classic, the interest is deducted. So what does that look like? So normal, you're buying something for 280, you put down 70% deposit, £70,000, 25% deposit, you get a mortgage of 210. With a bridge, you're actually having to put down more deposit because the interest is
Okay.
deducted. So instead of you putting down 70,000 like a buy to let, you actually have to put down 103,000 and change because your net advance is less.
Yeah.
That you're still borrowing a gross loan of 75%, but your net loan is 63. And the key with any bridge is to get off it as quickly as possible. So the
Mm.
quicker you pay it back, the less interest is used up and you get more money back. So the key in
Yeah.
is get in and out as quickly as possible. Do not hang around waiting for builders on a bridge.
Yeah.
Only draw down the bridge when your builders are ready to go in. And therefore you're on that bridge for the shortest amount of time. Um, so here's another example. His showing basically the interest. Yes, you are putting in a deposit, but that yellow box is the interest which has been deducted. So
Mm.
you are still borrowing 75%, but the net loan is 63.
Yeah.
And these are the classic terms out here. Together money. We've got gold status. I do that. I do like that little bouncy thing. It's quite funny. They've got cracking rates at 0.73% because we're gold members.
That's
If you went
fantastic.
direct, it will be higher. I do like Together Money. They're great for auction purchases because we can get mortgage offers out in 5, 6 days. They use
That's good.
desktop valuations. If you ever use an AVM, always instruct a valuation, physical valuation yourself Don't rely just on the AVM. Make sure you get some professionals around there.
Okay.
But yeah, Together Money, we're doing lots of business with them because they've got one of the cheapest rates in the market. They're very quick and very good on auction purchases.
Fantastic.
Now, the second option is when you're rolling the interest. So, because you're adding value to the property, the lender will allow you to borrow more than um, uh, uh, more than 75%. They'll actually go up to
Yeah.
80%, and then they'll roll the interest up, meaning you put even less money in. But obviously, because you're borrowing more money, there's more finance costs. The cheapest
Ah,
option will be the classic bridge. When you're starting to roll your interest up, because you're borrowing more money, it's going to cost you more money.
okay.
And this is the example. Instead of you putting in, if you're buying something for 280, instead of you putting in 25% deposit, which is 70,000, you're putting in 56,000. So it's quite a big difference there.
Yeah.
And your bridge is actually £14,000 higher than a normal buy-to-let mortgage because you're actually buying 225.
Yeah.
Um, and basically the interest is rolled up, and how it works out is that you actually, if you look at the whole loan to value of the loan, it's actually going to 92%,
Gosh.
because 80% plus the interest. So in theory, you're actually buying 92%. They can only do this because they're working off the uplifted value of the property. So they're going to
Okay.
look at your schedule of works, they're going to look at your floor plans, and they're going to, before they lend you any money, they're actually going to say, right, is this a feasible refurb?
Yeah.
Do
Yeah.
we agree? So
Okay.
that's this is a product which is available at 80. As you can see, they'll lend you up at 80% net loan to value here, up to 75% of the end value. They will allow you to do works up to 750, but you'll never do works up to 750.
Yeah. Yeah.
Most of my clients are doing works of 50, 60,000 pounds. Interest is rolled up, and yeah, you're getting rates at 0.875%, which is not, it's still under 1%, which is
Yeah, it
fantastic.
is. Yeah. Yeah.
So 2%
Not too
arrangement
bad.
fee, and this is with Castle Trust. It's great for large HMOs, blocks of flats, where you're doing a sort of more heavier work,
Okay.
because you need that uplift in value. It's
Yeah.
not,
Yeah.
you, these 80% products are not any really good for light refurbs because you're not really getting that much of an uplift.
Yeah.
The 80% products really work when you're getting a big uplift in value.
Yeah. You could have like a meaty deal.
Correct.
Yeah.
And the last one is when you're funding the purchase and the build, and how it all works is they work backwards from the NGDV. In this scenario, we've got a person buying something for 280, they're spending 200 on it, and the NGDV, the valuer agrees it's going to be 700,000. So what they do is they look at the NGDV, they say, right, we'll give you a pot of money of 70% of the 700, which is
Yeah.
490. Yeah. And that pot of money is split between the refurb cost. They take off the refurb cost first, and any money left over will allow you to use as the purchase pot of money. So it's a lot more complicated,
Hmm.
and you are going to have monitoring surveyor visits. The funding is done in arrears. So generally, they split the build fund up into four to five to six chunks of money,
Tranches. Yeah.
tranches, and that's funded in arrears. So you could have four tranches of £50,000 here. So you spend the 50, then a
Okay.
monitoring surveyor comes around and then gives you the 50,
Ah.
and
Okay.
then repeat, rinse, repeat, repeat,
Yeah.
repeat. Now, this is the most expensive option because you've got those monitoring surveyor visits. I mean, the initial report's going to cost you at least £600 to £700, and each visit's going to cost you £300 to £400 just to
Okay.
release the funds. And you're borrowing a much greater quantum of money compared to just borrowing 75% of the money day one.
Yeah. Yeah.
So you do, if you are looking to borrow for the refurb costs, you basically need a good uplift in value and you need a big enough refurb to actually warrant it. If you're
Okay.
looking for, if you're doing more of a light refurb, I would look at more of the classic bridge.
Yeah.
If it's medium to heavy and you've got the money to actually fund the build, um, Castle Trust 80% interest roll up works well.
Yeah.
And if you've got a meaty enough deal where you've got that big enough uplift in value, then we can consider funding for the purchase and refurb. So hopefully, and here's a
Oh,
classic
yeah.
product here.
I
So
was
they're
just going to
gonna
ask you what product, yeah,
yeah.
would be for
So
this.
we've
Yeah.
got a product here. They're lending 75% loan to value, up to 70% loan to GDV.
Okay.
Again, they will lend you. They max works is 750, but I've never come across a case where you're doing a refurb for more than
For that.
750.
Yeah.
Uh, they've got minimum drawdown chunks of 25,000, interest
Okay.
rolled up. They will fund 100% of build costs. And because they're funding a little bit more in terms of loan to, there's more uh, higher quantum of debt, they're going to charge you a higher interest rate.
Yeah.
So
Okay. Yeah.
instead of 0.887, they're now charging 0.9.
Okay.
And at the bottom, you can actually see the fee scale for the initial monitoring survey report is they're looking at charging £415 plus VAT, and each other report they do come out
Will
is
come.
£258, which is very good value.
Mm.
I've seen most lenders charge a bit more than that, at least
Okay.
double.
Okay.
So
And what lender
yeah,
would
so
this be?
yeah, this is Castle Trust.
Also
I
Castle
like
Trust.
Castle
Yeah.
Trust. Yeah,
Hmm.
yeah, a good solid lender. They also reason why I also do like using Castle Trust is that they also offer exit products as well. So if you do start off with them, at least you know, just in case we have sorry, God forbid, COVID 26 or COVID
Yeah.
27,
Yeah.
at least you know if you go with a lender which can offer an exit product, you've got that peace of mind. There's
Yeah.
exit funding in the background if something goes dramatically wrong.
Yeah.
Okay,
Yeah. Which
so
is good. Which is good.
which is good, and going with a medium-sized lender and not a small lender, we're not going to have any funding issues. I've in the past, a few of my clients have come to me saying, I've gone to X lender and they've run out of money.
Mm.
Bruce, can you help me to find me another lender?
Yeah.
Uh,
Wow.
that's because they used a small funder and their funding line uh, uh,
Just dried
dried up.
up.
So,
Yeah.
yeah,
Gosh.
I like going with the bigger mainstream lenders because I know they're fully funded.
Yeah. Got some money behind them.
Exactly. Well,
Yeah.
so see, hopefully, so that's covered off the three classic ways of getting refurb funding. And if people got any questions, please reach out. Here's my contact details.
No, fantastic. I just wanted to ask one question. Is there any sort of, what would be your two expert tips for people who are going down the bridging line that people really have to do or really have to think about or consider?
Builders quotes.
Builders quotes.
Make sure you get a reputable builder in and get personal referrals.
Ah,
Someone who's worked with a builder. So reach out to your property group and say,
mm-hmm.
look, I'm doing a build in Coventry. I'm doing a build in Birmingham or Portsmouth or whatever.
Yeah,
Can anybody recommend me someone they've worked with in the past?
yeah,
Because
great idea.
that's a great start. Yeah. If and also quiz the builder about what projects they have done in the past. Don't feel scared. Can you show me a few examples of what you've done in the past?
Yeah,
Have you done C3 to C4? Have you done C3 to sui generis?
yeah,
Have you done a loft conversion before? Have you done a side return before? Can you show me
yeah,
examples? Yeah. The delays with builders are the biggest issue I find, with actual the development itself.
Yeah.
Getting the actual money, solicitors. I'm
Uh-huh.
having problems with clients, solicitors, and bank solicitors currently. So top advice, especially if you're looking at bridging funding,
Mhm.
get a medium-sized solicitor firm which has got 3 SRA managers.
Okay.
Then you know they're of a decent size. So if a solicitor's off ill, someone else can come along and pick the
Jump
case
in.
up and get it over the line for you.
Yeah.
Especially now we're in, well, this is July, August 2026.
Mhm.
Everyone seems to be on holiday.
Yeah.
So,
Yeah. Yeah.
yeah, so get a medium-sized firm that you can have someone can step in just in case.
Okay, so basically just make sure your power team is ace.
Correct.
Yeah.
Correct. Because, 1 weak link breaks the whole thing. Yeah.
Breaks the chain. Yeah.
Breaks the chain.
Yeah.
Yeah. It's crazy that you can cause, builders delays will cause you higher costs. Yeah.
Yeah.
Solicitors not doing their job, you may
Yeah.
lose the deal.
Yeah.
We'll go as fast as we can,
Yeah.
but we are reliant on solicitors and builders
I
being the
mean,
brokers.
if you, as you said, when you're borrowing at this level, even a month is a huge amount of
Yeah,
money.
exactly,
Yeah.
exactly. I
Yeah.
mean, if you're buying in that development appraisals, 280 purchase, 200 build, you're looking at a pot of money of 490. That potentially at the end of the build could be costing you, I don't know, 4.5 grand a month. So 2 months delays, that's nearly 10 grand.
It's a huge amount of money, isn't it?
Yeah. So you
Yeah.
need the key with any BRR, get in and out as quickly as possible.
In and out as quickly as you can. Yeah. Yeah.
Correct.
That's a good motto. Thank
Cool.
you,
Thank
Bruce.
you.
Thank you so much. And for everyone, please, if you liked our video, which hopefully you did, please click and subscribe. And again, all of Get Social with Bond Finance videos will be on Bond's website. That is www.bondfinanceltd.co.uk. Thanks, Bruce.
Pleasure, Sarah. Lovely to see you again.
You too. Bye.